How to do call options on Robinhood. Options trading has proved to be a great tool for limiting your losses while keeping the scope of unlimited gains at the same time. To realize and take advantage of this fact, we will explain option trading so that you understand certain concepts about the functionality of options, their types, and the different strategies that you can use to earn an appreciable amount of steady income for yourself. To explain option trading, we will need to explain options first. Depending upon the various perceptions about the market performance, investors trade in contractual financial instruments called options. To enter into an options contract, there has to be an options holder or buyer and an options writer or seller. The options holder buys the option or right to buy or sell the stock of shares at a particular price mentioned in the contract called as the strike price. If the options holder exercises the option, then the options writer is obliged to sell or buy the stock of shares at the strike price irrespective of the prevailing market price. The options holder obviously has to pay a price for possessing the option, and this price is known as options premium. The options holder and options writer take risk of losing on chance and take opposite stands on a particular situation, which is usually fluctuation in price of stocks, commodities, and even value of the index. The amount of gains that you can earn in option trading are unlimited, as the price of the stock can theoretically rise to any extent. But the loss is limited to the amount paid as option premium, which is quite small as compared to the scope of making profits. The chances of loss can be decreased as compared to those of gains by using the correct strategies. The following strategies explain option trading methodologies in detail. The simplest type of options trading strategy is the call option strategy. Consider the following example to explain option trading using the call option strategy. Suppose you are the option holder. This means that you buy an option which bets on the rise in price of the stocks is in 6 months' time. If the current price of the stocks is $10 and you expect the price of ZIS to rise above $15 in 6 months, you have a bright chance of earning some profits. In order to do so, you buy a call option by paying a premium of $100. Let the options trading at present have a strike price of $13 per share. Now, after 6 months, if the stock ZIS is trading at $17, then your bet would prove to be correct. You can exercise your option for 100 shares and buy 100 shares of ZIS at $13 instead of the market price of $17. If you bet on the fall in the price of the stock, then you would buy the right or the option to sell the stock ZIS at a price higher than the prevailing market price. If you want to take advantage of both the rise and fall of the price of the stock, then you can adopt the straddle strategy, in which you can buy both the call and put options at the same strike price to even out your position. These 3 basic strategies explain option trading methodologies, and you can try them out as a beginner in options trading.